we do not have a soft landing. And everybody who speaks of a soft landing will have to tell me, how can you have a soft landing when the consumer is still struggling as they are? And if you look at the stock market also, we are up 750% since 2008. That's a compounded annual rate of around 16% per year, every year. That is not normal. And if we look at those charts and we just say, and these facts, we say, well, it's the biggest bubble ever. And say, don't think in the short-term range we're going to see something great for gold. But I think what's going to be the reaction from the US administration and from the Fed is going to create the perfect environment for gold and for silver and so on.
Hello and welcome to Soar Financially, here from the floor of the Deutsche Goldmesse in Frankfurt, Germany. My name is Kai Hoffmann, I'm the @JR Mining guy over on X, and of course, your host of this channel, and I'm looking forward to doing an in-person interview with Henrik Zeberg. Henrik, you're the Chief Market Strategist, Chief Economist over at Swissblock, and it's great to meet you in person. We've done so many virtual interviews.
Fantastic to be here, thank you.
We were overdue for an in-person one.
Yeah, we were, thank you.
Really appreciate you coming. You're a keynote here at the conference. Really appreciate you accepting our invitation. We have lots to catch up on. We spoke about three and a half months ago, and a lot has happened since. Maybe we'll start with a really broad overview on the macro. Where are we at right now in the cycle? Like, what does the economy look like? What's your assessment of the financial markets right now?
All right, yeah, so we're still in the same path. I mean, the economy is a supertanker. A supertanker doesn't turn on a dime, it turns slowly. And what we start to see is that turn. And if we just look hard enough, we'll actually see that there are many indications of that turn. If you look into what is the strongest part of it, what we have seen for having a strength for quite some time is the labor market in the US. But we also start to see now that the US labor market has shown some weakness. If you look into the continuous claims, you'll start to see that they roll up. If you look into the revisions on the NFPs, you'll see that they actually come down. You actually had quite a lot of revision this year already, which is normally what we see. And if you look into also the part of where we look at the household survey versus what we're coming out of the BLS, you'll see also that there are big discrepancies in what the numbers are in terms of how many jobs that have been created. So something is not really right on the labor market. And if you look to the rest of the world, and you look to Germany, and you look to China, and you look to Japan, things are not looking great. Topping in stock markets around the world, and we actually start to see that capital rotation into the US. So I stick to my thesis, I stick to my call. We're going to see a recession. It's going to set in much sooner than most people understand.
Yeah. Let's maybe drill down on the unemployment number first. 4.2% doesn't sound like it's a problem. Like, just if you look at just the number itself. Unemployment, I looked at the 10, 20, or a longer term chart actually on trading economics the other day, and unemployment always spikes. And it has a run up, spikes, drops off, and we're just starting to see that run up. It's like, personally, I'm not worried about the 4.2%. I'm worried about the momentum of change and how that could accelerate as well. Is that something you look at? And what's your forecast for the unemployment rate? Like, 4.2% isn't a problem.
You're hitting the head of the nail here. I mean, this is exactly it. It's not about the level. The level at this point here is fine, but if it just remained here. But the problem is we do not have a soft landing. And everybody who speaks of a soft landing will have to tell me, how can you have a soft landing when the consumer is still struggling as they are? If you start to look at the delinquencies on credit cards, if you look at everything that has to do with the US consumers, they are not happy at this point here. So the problem is right now that the consumer is not happy, and that you can start to see coming into the labor market. So when you look again at the labor market, you'll see that the continuing jobless claims are moving up. And that means that people are actually not able to find jobs. And if you look at the average length of unemployment, it's moving up. That means that now we are moving into something where we haven't, the higher levels of the unemployment in terms of how long people are unemployed than we have had, the whole period from 1950s to 2009. So we are seeing a deterioration in the labor market just happening a bit slower this time, which may be due to all the stimulus that came out of Corona, which has been delayed by 3 months to a normal recession, to the financial crisis. 2 to 3 months in terms of delay. That's all.
Yeah, it's like I looked at the chart, and one thing I've noticed, like, it doesn't stay flat. It doesn't plateau anywhere. No. Like, neither do the downside nor the upside.
Exactly.
It spikes, comes down, spikes, comes down.
When it spikes, you have the recession.
Yeah,
and you have the momentum right now.
Exactly, that's exactly what it looks like right now.
Correct.
Lagging indicator, obviously, the labor market. You said 3 to 6 months.
Coincident. It's actually with the economy, but yes. But so the lagging indicators would be more like the yields and interest rates. Yeah.
Where do you see it spiking? Is there like, do you see a level, or is like where you say, okay, now might be the time to think about a reversion?
But what I'm looking at is that there are 4 indicators that I'm looking at really to see whether when the recession starts. One of them is the 10-year minus the 3-year yield. If you look 10-year minus the 3 months, yield, and if you look at that, that's very close to uninversion. Uninversion of that will be that we mean that we are very close to things that start things to unravel. If you look at the initial claims, we need to see them spike up. They haven't done that yet. But as I said, the continuous job claims are still, moving higher. And if you then look at the 2-year yield, also we start to see that decline. For now, it's been bouncing over since late September, I think, into October and November. But I still see that as a bounce, and I think it's going to come strongly down. And then there are a few others that will tell us that we are there. So when will we see the spike? I think into Q1 you're going to see a spike starting to accelerate.
Did you look at the labor market and break it down, like where the jobless claims coming from? Like what sectors potentially like hit the most or the worst?
I don't do that necessarily. Okay. I mean, it's not. To me, it's more about the general picture here. The general picture is that, especially also, do you look across the world, because it's not just the U.S. game. If you look across the world, things are not looking great.
Yeah, I'm just trying to figure out, like, where should I be paying attention to the quarterly reports about layoffs? Yeah. Is it the Targets, the Walmarts of the world, or is it more the Macy's or so that I should be looking at for layoffs, for example? Right. Housing market is another interesting one in the U.S. Like, I'm not sure if we talked about it in the past, but the Fed cut rates in September, and all of a sudden mortgage rate jumps up. Mm-hmm. What does that tell you?
So first of all, again, the Fed is not driving yields. I mean, this is a common misunderstanding. Market yields is based on the demand for capital and the supply of capital. So when you have a slowdown in the economy, yields will start to roll over, and that happened already in 23. We started to see that decline, and then we saw an acceleration of that decline from May of this year. Then from September on, late September, we saw a spike. And that's what people are talking about. But really, if you look at the short-term yields, you'll actually see that they have actually sort of dropped quite a lot. And they're dropping even faster now also in Germany. So the thing is, things are not looking great with that. The only thing we have had so far is September, October, and November, a spike in a bounce in yields. And the Fed will set the Fed rates accordingly. Right now, the Fed is so mistaken. They are way behind the curve when it comes to looking at the economy. And that has to do with the lacking leading indicators and the whole understanding of that. They look at inflation. Inflation is lagging the economy. So if you look at they were also talking about inflation and fear of inflation in December 2007, which was the month of the recession setting in, which was a huge deflationary bust. I mean, now again, the same. They talk about, the fear of recession at this point, when oil is about to roll over and has had actually quite a big drop. You see copper doing the same. And you see that, again, also coming back to Germany here, you'll have the ZEW was terrible numbers we saw here, and you haven't seen these low numbers. So the world is not a good place. Demand for things is not showing us that inflation is going to go up, and yields are going to come down. That's the way the world yields itself.
Yeah, I love the Fed is saying they're data dependent, but as you're saying, like they're looking at the lagging indicators.
They do.
They're looking at lagging data.
They do.
Right? Were you surprised that Powell pumped the brakes a little bit in the last meeting? They said, December will be data dependent again. He said before, like, we're going to cut twice, like no problem. But he sort of took a step back. Is he getting some data or information that gives him pause?
I don't know. Honestly, I don't know what's going on. I mean, they are terribly late. Yeah. And it's going to be, one of the key reasons we're going to see this crash is going to be even harder. I think they've gotten spooked by their own actions. They think that they let out the genie of the bottle in terms of inflation, and I think that is wrong because it's not just about the Fed; it's about the whole world, first of all. And second of all, what we had was a supply crisis in Corona, where we just put a lot of demand into the world. So everybody was stimulating the whole, every administration around the world was stimulating. When you have a supply shock, and you then put demand on it, you get inflation. And now the Fed is spooked of that. So if you look at the inflation level that we have right now compared to what you saw back the month before we saw the onset of the 2007 recession, and also in the dot-com recession, inflation is now way below those levels we were at just a month before. And guess what? The job numbers are also. So that the Fed is doing this now is simply just a misunderstanding from their side, I have to say.
Yeah, it's interesting. Like one thing that stuck with me, I think they're looking at core PCE is the one that they're looking at, and they're saying, hey, we're at 2.1%. Our target is 2. Let's cut again. Yeah. It feels like they're already beating somebody who's already on the ground. Yeah. Like they're kicking somebody that's on the ground. Like, absolutely. Like they're overdoing it.
Overdoing it. But that's what they do, and they got scared. They saw inflation. They thought you saw Yellen was out saying, we think it will be about 2.5% as a maximum, boom. No. And then it flew up to 9. I mean, that just shows how little they understand what they're doing, honestly. I mean, it's shocking, actually. You would hope that there was some kind of an adult in the room, right? But somebody who says it's 2.5% as a maximum, it goes up to 9%, and now they say, oh, we're afraid of the inflation, it's 2.4%, and they keep, pumping the brakes here. It's ridiculous. I have to say, they are so late.
More of a philosophical question. The new U.S. president said, "Oh, I want to have a say when it comes to interest rates." Is that a good or bad idea? Do you think he can do better, or that person can do better?
Extremely bad idea. I mean, I cannot explain how bad it is. It'll be good for inflation, but it'll be extremely bad for the stability of the world.
Yeah. Okay. No,
I think we've seen this before.
It's more of a philosophical question than anything else.
I know you Germans will have also an idea about that.
We do. I envision you like a marathon runner. You have a goal. You say something at the beginning, and you try to achieve your end target, like the marathon. And there's always macro shocks happening. They try to punch you out of your path, right? Like U.S. election is a macro shock, for example. Chinese stimulus, macro shock. How do you throw that into your calculations and like forecasts? Like, is that throwing you off at all? Like, how do you factor that in? Is it maybe a time thing, or like how do you measure that?
Actually, I don't use that too much. I mean, this is what the media likes to do. They like to say, well, now this comes in and that changes the picture. Well, it doesn't. Guess what? It's a $50 trillion economy across the globe, or northern. I don't know what the global GDP is right now. And even though things will change, it's not about that. It's about Mr. and Mrs. Johnson, or whatever we call in Denmark and Germany also, what they do on a daily basis. It's about the job market, it's about the housing market. So when people think, oh, now Trump comes in and something can happen and he's a businessman and then everything will be fine, it's not happening like that. It's a super tanker where you have to understand the general basic things, and that is, how is the consumer doing? And the basic driver of that is how much are they paying in interest rates. And by the end of the day, it will take time for the supertanker to turn, but when it starts to turn in the other direction, there's not so much we can do about it. We can stop being stupid like the Fed is right now in not hiking rates, but staying as hawkish as they do right now. And then actually just, saying, okay, we need to look at something that is more leading in terms of where the economy is going. And that I think is a bad thing right now. So the shocks to the economy, we have seen it often. We have seen attacks here and there. It kind of makes a spike on the day, but then we're back and that's because the global economy is dependent on so many factors that thinking it might be a good story that media says, okay, now this comes in and that changes everything. It's a great story, but it's not just how things work.
Yeah, we've talked about this. It might be a bit repetitive, but I'm curious, like, what leading indicators should the Fed use? What would you suggest?
Well, first of all, they should start to lose, as you mentioned, the momentum of things. So when we start to see the momentum of the unemployment rate starting to move up rather fast, and we start to see, for instance, we got the yield spreads also, and we start to see the yield inversions. Then they should start to think, okay, maybe things are not as great as we think. But it seems like they are not paying attention to that at all. And I just have to say, they haven't, saved the economy ever. First of all, whenever my business cycle model has been suggesting we're going to have a recession, it has come every time, despite what the Fed is doing. The Fed was even standing in 2008 in February saying, "Oh, we're ready." In 2008, ready to act if we see a recession. Guess what? We were 3 months into the recession, so they haven't honestly no clue. We just have to see that. How many times do we need to see that they honestly have no clue? So I think we're heading in that direction, and unfortunately, not so much we can do at this point here. They need to start following this in the next cycle, and right here now. It's about understanding that we are, heading towards the cliff.
Yeah, the cliff is the deflationary bust.
Yes.
Right? Let's explain that a little bit. What does that look like? I know we've talked about this before, but maybe just to get everybody on the same page here. What does that mean to you?
So first of all, we have to look at where we are in the world in terms of with asset valuations, and we have the largest bubble we have ever seen. I mean, in so many parameters, we can just look at it and say, when you look at the market GDP the market capitalization to GDP in the U.S. We are 203%. That is almost double what we had in 2007, double what we had in 1929, which were great or huge bubbles. And it was at 129 in 2000, which was a ridiculous big bubble where we did .com, and it's 203% now. If you look at the price to earnings, it's the same thing. Even though it's forward price earnings, it's the same levels we're looking at. We have a crypto market where we see we see meme coins exploding higher. We have thousands and thousands of coins. Everybody seems to have the new idea about, why this is the best coin. We have, a Bitcoin at 100,000, and everybody seems to understand why that is the case. What I say is the case, and if you look at the stock market also, we are up 750% since 2008. That's a compounded annual rate of around 16% per year, every year. That is not normal. And if you look at those charts, we just say, and these facts, we say, well, it's the biggest bubble ever. So deflationary bust, what will that mean? That will simply mean that the hot balloon here is there's going to be, the common hole in that. The air is going to come out, which means that valuations will shrink. It's going to be bad. A lot of value will be lost, and you're going to see a credit crunch.
When you mean deflation, do you talk about asset prices, or do you feel like I'm going to feel it as a retail consumer? I go to the store, the bakery, the bread is not going to cost €5 anymore, it's going to cost €3 again. Is that something that we could see again, or is that going to be handed down, or is that really just more on the asset price level, like S&P 500, gold, oil, and everything else, Bitcoin that's run up as well?
So I think you're going to see that it will first come to the asset valuation. So first you're going to see stocks starting to decline. I'm not saying it right now, right here. This is we are in late November here, just so everybody understands that. I'm very, very bullish. I'm still risk on, so it's like that. But the moment when we see that the top here, which I think we have seen in Nikkei in July, which I think we have seen in the Nifty, which are quite rather big markets, then you're going to see asset deflation first, so actually the value coming out of that. But that always, like when we see a bubble to burst, carries on a recession with us. When you get a recession, you're going to see normal prices also coming down. So you are going to see a strong decline in prices for a certain amount of time until the moment when the Fed reacts.
Interesting. Like, do you expect a reaction in the next two meetings? Like December,
No.
I'm personally expecting nothing.
No.
January 28th is the first meeting after the new president is in the
Fair
office. So
way out. I mean,
Okay.
they that would mean that they will have to look into their leading indicators.
you mean reaction meaning QE all of a sudden? It's like,
Yeah,
overdoing
we're
it.
talking
Like
about
that's-
something at the moment after when they look, the
Yeah.
deflation, they stare at deflation in the eyes again. Then that's the reaction. That's the QE. That's the helicopter money. That is the whatever they're doing, buying of assets or whatever they could do to pump up things again.
monetize debt.
Monetize debt. Yes.
By the bonds. Because next year, I've talked with other guests about that as well. It seems to be a massive
Yeah.
liquidity year,
Yeah.
or pivotal liquidity year. Because I think $15 trillion, I need to look up that number actually. I
Yeah.
keep using 15, it might be
Yeah.
something else, but that needs to get refinanced.
Yeah.
And a lot of it is short-term T-bills.
Yeah.
Do you see any issues with that? Like, what does your analysis tell you? Do you see a liquidity crisis maybe looming? Is that a danger that we should be having in our bingo card this year?
So
Or next year?
obviously, if things are starting to decline, like what I'm suggesting here, you see that the consumer, and we're going to see a spike in unemployment. Banks are going to have a problem, and when banks have a problem, we know that there will be a credit decline and maybe even a credit crunch where banks will start to call in loans. We may even see financial institutions wobble and fail, and I think that is going to be the case. Actually, I think you actually have started to see some of that in Japan already, and I think that falling out has not stopped yet. I think we are at a pause from what we saw in August, but I think it's going to continue in Japan with the financial institutions there, and I think you're going to see that coming to the rest of the world also at a later stage. But even without that, I think you're going to see some of the financial institutions really not performing well, actually having a lot of problems going into 25, and that is a credit crunch, and that is where a lot of people feel the heat.
Well, what is it saying? You can't you can't pay back a $10 million loan. You have a problem. You can't pay back a $100 million loan. The bank has a problem.
Yeah.
Forgot what the third part is, but it sort of fits in what you're saying, right?
It's, the bigger, then of course the bank has a problem because you can just go bankrupt, and then it leave it all with the bank. And I think that is what you're going to see, because obviously the credit system is based on that they do not hold all the money that they lend out, and the credit that's the credit cycle, and that's how it's supposed to be. But it's just not not set for a big asset bubble to burst, because if it bursts, values will be lost. That means that then you'll have to call in some loans, and you'll start to see that kind of cycle roll.
Yeah. A bit of a micro question actually is about Scott Bessent. I'm not sure if you've heard the name, if it's come up, but he was suggested as a new Treasury Secretary in the US, and he's a big fan of Shinzo Abe. Meaning like Japanese policies, like let's buy our own debt and just inflate our way out of it and we'll be fine.
Yeah.
Sort of what I've been saying for the last 3 years. I can't shake the feeling, because I think we might have talked about it. Do you see the US going the way of Japan? Like, I never had any hard facts for it, and now we've sort of, like with that announcement, there might be an indicator that the US might go that way. increased debt.
So I think we are different, but not but the U.S. is different from Japan in the way that Japan has actually been leading in that cycle. So they've been able to do that while there was still enough of room for the rest of the world to maintain, manageable levels in terms of interest rates and so on. But Japan has just gone full, cycle, and they are just at the end of that cycle. They're at the moment where Keynes said we're all dead, because what do you do when you have stimulated, down to zero? Yeah. That is what you had, zero rate of.
I think Japan is 30 years ahead of the US.
Exactly.
That's what I'm like. That's the model I'm looking at.
Correct.
Because the yen was fairly strong back in the late 80s, early 90s. It's disappeared. It's not really a factor anymore. Interest rates are near zero.
Yeah.
And debt is at 250% or whatever, 240 something. That doesn't matter. Yeah. But so I see the U.S. going the same way, and but with Trump in the office, he might devalue the U.S. dollar just to make the America great again.
Yeah, but I think you're getting to something there, which is also be great for and that's where I hope I'll not be carried out by and burned on the fire today, because I'm actually thinking that I'm going in and say don't think in the short-term range we're going to see something great for gold, but I think what's going to be the reaction from the U.S. administration and from the Fed is going to create the perfect environment for gold and for silver and so on. So I think what you're going to see is that, yes, at some point here, when we get further into the deflation, you'll see that the Dixie is going to reach 120, 122. And at that point, I think you're going to see a big reaction from the Fed, from the U.S. administration, because otherwise the rest of the world will simply be strangled. I mean, everything will just be strangled if we get to 122 and beyond that. So I think you're going to see that, and that will create a new environment. But I think we're already seeing this, that we have shifted, and I think this is a very, very important point. We have shifted from what is a deflationary environment, which was set in motion in 1981. Some say it was Volcker, I say it was the environment around the whole economic environment, but when he killed the inflation, and until what we saw after Corona. The inverse Volcker was what we saw after Corona, where there was an extreme overstimulating of the global economy at a time where you had a supply crisis. This is the opposite of what Volcker did, was to hike rates into something where you should have lower rates. So what we've seen there is that we've seen the opposite right now, and if you look at the long-term rates now, they are actually now, as I see it, in a new inflationary environment. And this is very, I'd say, inflationary environment. It's been in a deflationary environment for 40 years. Yeah. Now we are in new inflation. Does not mean short-term, 1 year ahead, that we will not see deflation, as I say. But it says in the longer term, 5, 10 years out, we start going to see yields and inflation moving up and up. So we need to start learning from, not from we saw in the 70s or in what we lost the last 10 years. We need to start learning from what we saw in the 1950s and 1960s and 1970s. That's the path we are embarking on, as I see it.
Yeah. Let's cycle through the asset classes a little bit and check your forecasts. What it's going to look like. You mentioned stocks. You say you're still risk on. Risk on? Yes. It's going to go higher. What's your prediction? Let's say S&P 500. I think I remembered last time we chatted was 6,100. Have you revised that target at all?
I think I said 61, 63, but I may have said but 61, 63, yeah, it's still there. 63 maybe be the top end of it, but I think that's where we're going to go to. We have seen. The structure that I'm the structure I looked into is leading us right there. And I think it's going to be faster than most people think. And then it's the fallout could be in Q1 of next year.
Dixie, you touched on. We're right around 106.5 right now. It's ticked up tremendously the last few weeks. The trajectory is intact to hit 120, 125. I think you mentioned.
Not from here.
Not from here.
And I actually think that was just a spike today, so I just checked it here. But I actually think that I think there probably will be a top end now, and I think we're going to see the Dixie.
Oh, we're at 107.5 actually.
Exactly.
Today.
Yeah. It's just a spike. But I think you're going to see that as a top, a short-term top now. Then you're going to see that you actually drop some just below 100 and on the Dixie. And I think that is going to power the whole risk-on environment. The Dixie has been extremely strong, and I think the reason it's been so strong is because you see the capital rotation from other countries, so capital coming in from other countries into the US, and that simply pushed the Dixie up. Yeah. And that has, the strength that we have seen in risk assets, despite that, has been quite remarkable.
So looking at just price price mechanism, or just the price tables here actually in front of me, it seems like we've got a bit of an everything rally going on just the last couple of days, which is a bit confusing because gold is recovering, the Dixie is spiking as you mentioned. Why is everything moving up, especially in tandem, which shouldn't move up in tandem?
Yeah, but I think the intraday or the developments is not something that's not how I go about things. I look at it if you're going to see bigger tops in things, and I noticed that if you look at the silver, for instance, it moved up in a kind of a wedge on the weekly, and it fell out of that wedge. Now it's probably retesting that wedge, and I think it's going to come down further. I think there's a good chance we have seen the top in silver and gold at this point.
We'll get to the silver and gold in a second. In more detail, one asset class I want to touch on is the bond market.
Yeah.
We had a really good discussion with Christian Batzian here about the 20-year. He sees the 20-year as the real dollar, which is interesting. It's a bit of a different thesis, but I kind of understand where he's coming from. Mm-hmm. Looking at the 10-year with 4.4, the high was around 5% yield on that. Like, where do you see things going? It seems like term risk and the term coupon is increasing here. People are starting to get worried long term about bonds. Yeah. Is that just a short term blip, or is that a longer term trend?
So that's back to as I said, the inflationary environment that I think we moved into. I think there is we've simply seen a major shift. It's going to be clear for us when we get a few years down the road. But I think there's a major shift here, and it's actually meaning that we're not going to see a new all-time lows in bonds. Yields. I actually thought that 2 years ago, before around 2 years ago, it was probably a bit different view there. But I think it seems like now that we've actually seen the secular bottom, and that we're going to still see the decline into the recession, because it's all about the macro environment. So even though people say, yeah, we'll be risky, we don't want to be in bonds. You want to be in bonds if the economy hits a recession. And so I think there is the yields will still be coming down in the next, let's say, 6 to 12 months time frame. And then you're going to see that there's probably going to be a new bottom, a little higher than what we saw on the all-time lows. And then I think we're going to move up from here. So yeah, I think there is a chance that people are now starting to think, okay, inflation is actually a real thing again, and that is going to be priced into bonds, which means that there will be a time where bonds is not a good thing to hold for a longer time. Yeah. And if I get it right, I think we're even going into a stagflationary period, which will be very bad for bonds and equities.
Yeah. So you're actually putting quite a bit of weight on the term risk as well. So if I understand you correctly, if the recession hits in the next 3 to 6 months, you'd rather own like 2 years or 1 year T-bills.
Yeah, at this point,
yeah. Okay. I just want to go through the asset class and see where your head is at, because we have to talk gold. We're at the Goldmesse.
Yeah.
And I invited you, we got a couple comments on X, of course, well, you're inviting Henrik Zeberg to a gold conference. Are you stupid?
Yeah, exactly.
No, I'm not. A, I like controversial views.
Yeah.
B, I like both sides of the table and come up with my own opinion. But you're actually a gold bug.
Oh yeah.
So you said yourself.
Yeah.
Let's go through your gold thesis a little bit.
So let me. As I said, I'll also say that today. I don't get carried out and burned on the fire. I think my target would be that gold could be at 36,000 by 36. So let's say in 10 years time, we could be like many times higher than where we are today. 20 times higher. Yeah. Why? Because I think that we are moving into, as I said, the new inflationary environment. And I think we're going to see also that there'll be a lot of debt monetization and so on and so forth. But it still does not, again, there is a path to that. Yeah. And I'm not sure the path is just straight up from here. And if you look at gold, you'll actually see that gold is up 50% from the 2011 highs. But you'll see that silver is down like 45%. The platinum is down like 45 or 40%. And gold miners are down like 40%, 43% from those highs. So we have to wonder, why is it that gold is taking off and all the others are not? And is it because gold is bubbling? Because everybody talks of it? No. Or is it because that there really is something to it? I think it's bubbling at this point where people have been too fast and jumping in on this and the inflationary thing. Does not mean that it's not right, because it is. But it does not mean that it's straight up from here.
You probably can guess the follow-up question.
Yeah, sure.
But the purpose of gold is different than it is maybe for platinum or silver even nowadays. It's a monetary metal.
Sure.
Right? So, of course, the central banks have been buying. How do you factor that into your thesis? Because that seems to be a bit of an outlier that not everybody had on their bingo card the last maybe 24 months, that the central banks are stepping in massively buying gold. How do you factor that into your thesis?
First of all, I've noticed also that central banks are not normally the best timers of buying when to buy gold.
I think England sold it, $200 per ounce or something at the bottom?
Gordon Brown, I think it was $10. Yeah. So I think there are, the reasons why they may not, try to time things. But obviously, we are moving into a more uncertain world. We're moving into a world now where debt is, so big as it is. So I think it's good and fine. I hope the Danish Central Bank does the same. But I think it's not enough to withstand the kind of pressure we're going to see from a deflationary bust. If people are going to lose their jobs, if you're going to see a credit crunch, things will be sold off. Equities will be going to be sold off. Crypto, like annihilated, and gold is going to be sold off. And I think you will see that. And I think and again, we also have to look into the fact that gold miners have not done so well. Why is it that we see the GDX, the GDXJ, have not performed so fantastically as gold has done? There's a reason for that, I think, and then maybe it has to do with that it's really not we're not in that cycle yet. For me, gold is actually, and I know this sounds crazy when you have a new all-time high, it's actually bouncing from a low. That's so I can show that on charts, and it's difficult to do here. But I think we're going to see that it's coming down rather strongly into that deflationary phase. And yeah, obviously there are buyers out there, but there will also be sellers. And credit crunch is not, and a Dixie at 120 will not be good for gold.
No, absolutely not. It's absolutely, the higher bond yields and the Dixie at 120 is definitely a headwind for gold, not a tailwind. Absolutely. You brought the GDX chart here as well. Like, as you said, it hasn't really moved, but you're still calling for a correction in the GDX. And is it just the flight to liquidity is just going to be held hostage as part of everything else that's going to be sold off?
Like that, yes.
Yeah.
Exactly. It's going to follow gold, so when gold comes down, but I think you can also see it has had a life of its own, and it really hasn't, taken the effect of the high gold prices.
Yeah. Maybe summarize, like it might be a bit of a repetitive question, but like, what do you want the investors to walk away with from here, like from your presentation later? It's like when they walk out of the room, it's like, these are the key points that I want you to understand. So
I think it's important to say that, even though gold can be a fantastic asset and will be, I think it is, and as I said, I'm a gold buck on 36,000 on 1 ounce of gold in 10 years' time would not be surprising to me. And much higher levels for GDX and miners and so on. Fantastic opportunities ahead, I would say. Extremely fantastic. We are at, the bottoming end of all of this. But what we need to factor in is just what is happening the next 6-12 months from here. And if you can weather that, and you can withstand that, then you will probably be able to, have some of the best investment you can ever find out there. Because I think when the whole thing, I will not say collapses, but when we need to have sound money coming back into the system, then I think gold will have a key factor in that. I think there's going to be a monetary reset. Gold will have a factor in that. And I think that is where you will also see gold starting to outperform, other assets it has, kind of struggled with, like Bitcoin. I think gold will be a better asset coming from, let's say, 25 into the 30s, 2030s.
Fantastic. Henrik, where can we follow your work?
So it'll be on at Henrik Zeberg on Twitter, and from there it's try just to reach out if you have anything you want to discuss.
Fantastic. Henrik, I really appreciate you coming down from Copenhagen to Frankfurt. Takes a bit of effort to come down. Always appreciate people traveling to the conference, and really appreciate you joining us.
Yeah.
Everybody else, thank you so much for tuning in here to Soar Financially from the Deutsche Goldmesse. Appreciate you watching. If you haven't done so, hit that like and subscribe button. It's a free way to support us and support our channel, and we tremendously appreciate it. Thank you so much for tuning in. We'll be back with lots more here from Frankfurt. Thank you.